All right, how to start a fund from scratch in 2026. That's the topic for today. We're going to dive right in. Welcome on, y'all. This is a live stream. Say hello in the chat if you're live. So we're going to end this video. I'm going to break down how I would go start a brand new fund in 2026. What formula I would follow. There's distinct points in launching a fund that I think are very applicable, especially for 2026. I run two funds right now. One of those funds is Fund Launch Partners. We actually invest in seed other funds. We currently have 10 portfolio funds. Actually, right now, there's a meeting, and I'm missing it because I forgot this live stream was happening. We're voting on, I think, 3 or 4 more deals to greenlight going into 2026. These are all startup funds that are all launching and scaling right now. So I am on the ground level working with our portfolio companies and companies inside of Fund Launch to help them build. And so these are the tools, the methods, the process that I would use to launch a fund in 2026. So when the iPad's ready, let's go down to it. You guys ready? Let's get into it. Welcome all. Good to see you guys live. So let's talk about this for a second. Launching a fund in 2026. Now, as you guys know, funds are an amazing vehicle. This is the world of private equity, hedge funds, venture capital funds. This formula I'm about to walk you through, called the Fund Launch Formula, applies for all of these. So whether you're doing a hedge fund, private equity fund, a venture capital fund, a real estate fund, private credit fund, this is the same strategy. We've actually helped people launch all of these types of funds in Fund Launch / Black Card. So you kind of see here. I wish I would have disguised it, but you guys are smart. Let's just go fast. The Fund Launch Formula is the way that I would launch a fund in 2026. And I'm going to give you some nuances for 2026 and how I would do this. But most people, when they want to launch a fund, this is what they do. They say, Bridger, let's call some lawyers. Give me the lawyers. And let's go call. This is how, again, people that are uninformed, don't understand the Fund Launch Formula. This is how they would go launch a fund. They would say, Bridger, let's go talk to some lawyers. And we're going to go call up a lawyer. And typically to launch a fund, it's anywhere from minimum 30 grand all the way up to, for a first-time fund, maybe 150,000. Let's call a lawyer. They're going to start helping draft legal docs. And those legal docs, they're going to draft some docs, and they're going to start to ask you questions. They're going to ask you questions about your frame and structure, your deal and strategy, your commitments, how they're coming in. And you may or may not know those answers. And so a lawyer will happily explain these things to you for $800 to $1,200 an hour. And lawyers love to talk slow. They love to go down tangents or rabbit holes because they bill by the hour. Gets their billing up. Let's say you do launch. I had a friend, this is a real life story. He did launch. He paid some lawyers. They launched. He then went to the capital markets. We'll explain all this in a minute, but he went and pitched real world investors here. The investors kept asking him for changes. They're like, hey, are you really going to charge that fee? Or how's this going to happen? Or things that he hadn't considered. Are you doing an American or European waterfall? What's your watermark? How are distributions going to work? And so he would go back to his legal team. And they're like, oh yeah, let's make sure that's included. And they would redraft the legal docs. And then they would redraft it again. And again, I'm not joking. I have a friend, he told me he had spent over $500,000 on legal docs doing this process. And he said, I wish, Bridger, you had taught me the Fund Launch Formula first so I didn't go waste $500,000 on legal docs. Now, his fund still launched. He did extremely well. He runs a $100 million plus dollar fund. So he did well. It turned out fine, but still, that's quite a startup cost when in reality, he probably should have spent 30 to 50 grand, something like that. And with the Fund Launch Formula, we actually spend even less on the startup fees. And furthermore, the biggest thing in the Fund Launch Formula, and I'll change colors. Let's go green. We build a fund investors want. That is the goal. That's the goal of the Fund Launch Formula. Most funds never launch. Most funds actually never take off. Most funds pay lawyers. They still have legal fees, but they never quite get traction. I've done this. The reason I say this, because I've done this before. I did not follow the Fund Launch Formula. It didn't exist. And we built a fund that no one wanted, or an idea that no one wanted. And so that's how we're thinking about it. Sound good? You guys ready to dive in? If you're ready in the chat, let's get into this. By the way, I was told to do some giveaways. We're going to do some giveaways. So if you're live right now, welcome on. Type a yes in the chat, and we're actually going to pick somebody live from the chat. Like, I'm not even joking. So type a yes in the chat. The yeses are all going to pop on my, right here. And then we'll actually pick someone live right here for, let's call it $100 to Amazon. Does that sound fair? And then we're going to go, there's a little bit of a delay here. I'll give you guys about 10 seconds, and then we're going to get into the fund launch formula. And I'm actually going to break down part 1 of the fund launch formula. So let me clean my screen out for a second. Type yes in the chat. You can type it as many times as you want. Type yes in there. What's up, y'all? I'll give you a few more seconds. Type it in. Type it in. Okay. 5, 4, 3, 2, 1. All right. I'm going to pick John Flores. John Flores, you've got $100 coming your way. What you'll do, we'll try to message you privately if we can. If we can't, just if you're okay, send your email to my team, and they'll make sure you get $100 to Amazon, or just email me at bridger@fundlaunch.com. That works as well. All right, let's dive into it. The fund launch formula here, and sorry, one last thing. If you see on my screen, we're helping people launch funds. That's what we do in fund launch. If you see here, we're doing a once in a lifetime kind of promo here. We've never done this in Black Card. You're getting $7,000 off Black Card, $5K to start. Again, if you want more help, if you want my team to actually work with you implementing all this, I will teach all of it for free. All of it is for free on my YouTube channel. But if you want help implementing it with a one-on-one coach, with a pitch deck designer, a full legal team to do this with you, that's what we sell in Black Card. All right, there's my pitch. There's down below. You can click. All right, let's dive in. Okay, when you're launching a fund in 2026, don't do this. Don't go to the legal formation, all right? Come start here. And you already see this stuff, but I would say start on this side. We're going to focus on 3 main categories of the fund launch formula. Number 1, focus on your deal and strategy. We'll come back to that in a second. Secondly, you're going to work on your frame and structure, structuring out the mechanics of your fund. And third, we're going to go try to get verbal commitments, real world commitments from real life investors for the goal of validation. We're going to validate that your fund idea is even good. That's what we're doing. And your frame and structure is even good. Your deal and strategy is even good. We're trying to validate all of this. And then and only then we're going to go to legal. So let me break this down for a little bit further. Now, I have 2 versions of the fund launch formula here. You have this version and then the complex version. You can see here. I'm going to kind of zoom in on the complex version for a second. Under deal and strategy here, the goal of deal and strategy, what we're trying to do, and again, if I was building a fund going into 2026 right now, I'm trying to find asymmetrical risk reward. Now, that's a fancy finance term for essentially this. It's something that you guys have probably all heard of before. I'm going to make this a little bit smaller. So this concept of, you've probably heard of, high risk, high reward, low risk, low reward. Have you guys heard of that before? So you have, if you have like an axis of risk versus reward, and you like drew it into these buckets, there is high risk, high reward, low risk, low reward, high risk, low reward, and low risk, high reward, right? That's kind of how a matrix would work there. You following? What we are trying to find are things that, if you have things that are low risk, low reward, that's not really, it's not asymmetrical risk. Things that are high risk, high reward are also not asymmetrical risk. The things we want are things that have relatively low risk for high reward. We want stuff in this bucket right here. Cha-ching. This is our bucket. Now you might say, well, Bridger, that doesn't exist. Things that have relatively low risk for high reward. Yes, they do. I was actually with one of the kings of finance, Mr. Ray Dalio himself. We were at the Greenwich Economic Forum. I actually got to shake his hand and meet him. It was fun interaction. I actually gave him like a 12-inch knife blade as a gift, and his security team about took me out. It was a custom gift we get. Anyways, different story, but it was pretty fun. Actually, I gave Ray Dalio in a custom box. It was sick, but like 6 of his bodyguards were about to literally take me out. It was quite a thing. I'm sure Ray Dalio will not forget our interaction, but he was actually thoroughly impressed with what we were doing. He's like, tell me more about your business. We talked for 2 or 3 minutes about fund launch, what we're doing, helping people launch funds. He's like, he thought it was phenomenal. Like he was actually thoroughly impressed. He actually turned to his assistant and said, hey, share our emails and contact, and I want to send you a gift, a return gift, just to what you're doing. And thanks for the knife, because he's a big hunter. We did some research. He's a hunting knife. And he's like, this is awesome. I want to send you a return gift. And so me and an assistant changed contact. Anyways, it went pretty well. Ray Dalio, we were with him, and he mentioned this. He said, at Bridgewater, which is one of the largest hedge funds in the world, I think $150 billion fund. Ray Dalio, when he was raising minimum check to invest with Ray Dalio, was $100 million was the minimum check to invest with him. I mean, he's like one of the titans. He said, we would try to find anywhere between 10 to 15 uncorrelated assets in a portfolio. What we found is we could reduce our risk by 80% without giving away any upside. Essentially saying, by diversifying with these uncorrelated assets, they would go from one of these buckets to they could reduce their risk by 80% while maintaining their reward, having high reward. Does that make sense? That's how they built one of the best hedge funds of all time. That's what we're trying to find, is asymmetrical risk. You can find this, by the way, in all sorts of markets. Real estate is a great example. Flipping a house is asymmetrical risk. For a seasoned house flipper that understands how to build stuff and general contracts and all that stuff, for them to flip a house, it's not very risky. I have a friend, he's flipped over 300 houses. He knows the ins and outs of flipping a house. He's done it 300 times. For him, flipping a house is not risky. But the reward is still the same. Knowledge and experience has reduced his risk. Now, if Bridger Pennington went and flipped a house, my family always makes fun of me. I'm not like super handy. If you're supposed, like my brother is like, I'll go build a deck tomorrow. I'm like, I don't know how to build a deck. I'm just not that guy. I go hire other people to build a deck for me. It would be very risky for Bridger to build a deck. It would not be risky for my, brother or somebody else to go build or flip a house. If you get the point. The point is, what I'm saying is sometimes the experience we bring to the table reduces risk as well. This is what we are paid big dollars to do, is find asymmetrical risk in the market. We are paid to find things that have relatively low risk for high reward. And in fractured small markets, the most asymmetrical risk exists. In large public markets, there's less asymmetrical risk, if not zero asymmetrical risk. And I could give you examples there, but we'll dive into it for a little bit. So if I was working on my deal and strategy for 2026, I would first start here. How do I find asymmetrical risk? A framework I like to use is this. This is risk control return. I go through and map all my risks, things that I can and can't control. Both are important. I go and see how sensitive I am to those risks. And then I drive what would be my worst case, base case, and best case scenarios for those things. Following? An example on this, let's take real estate, for example. What are things that we can and cannot control in real estate? Well, in real estate, we can control like our purchase price. We can control rent. We can control how much debt we put on the property, etc. Those are things we can control. What are things we can't control? Well, we can't control like if a war breaks out. We can't control interest rates from the Fed. We can't control supply chains. Now, those things are still important. Just because you can't control interest rates, it's still an important thing. So what we do then is we say, okay, we run an Excel model and we say, how sensitive is our portfolio to a +1 or a -1 interest rate change? What if they jack up interest rates next year? Does that kill our portfolio? Or are we not that sensitive? Whether rates go up or down, actually our portfolio doesn't. Our worst case, base case, and best case doesn't really move much. Or, interest rates, if they move interest rates down a point, our best case scenario, it goes way up. And our worst case scenario goes way down. So what we're trying to see is how sensitive are we to each variable in our deal or portfolio. Are you following? Is that making sense? Type in the chat, by the way, if you have questions. I'm going to answer in a minute. Type in the chat if you got any questions. Hopefully that makes a little bit of sense. Again, if I'm launching a fund in 2026, that's what I'm thinking about first. What is my deal and strategy? How do I find asymmetrical risk? Second on that, who are my team members, right? And you can see my 3 roles in every fund. If I'm struggling to find asymmetrical risk, it's typically not a how problem, it's a who problem. I need to find a better teammate or team member to help me reduce my who. Back to asymmetrical risk. Let's say we're starting a business together. We're going to build a business. And it's, Bridger and you. Me and you are partners, okay? We're starting a business together. Here we are. Well, there's a certain level, like an outside investor would say, hey, there's a certain level of risk and there's a certain level of reward on Bridger and us starting a business together. Let's say we announce our third business partner is Elon Musk. Would investors what would that do to our risk and return if you're an investor? Well, let's call this risk and let's call this return. Would risk or return go up or down? Well, you could say there's some risk to Elon Musk. He's kind of an eccentric person. Maybe risk goes up a little bit, but also he's the richest person on earth. The risks might go down because like every business he touches turns into a $100 billion, if not trillion-dollar enterprise. So what happens to our return profile? Probably, if I was an investor, I'd be like, yeah, I would say the return. If Elon Musk is interested, yeah, these guys are probably onto something. Just by adding a business partner, we can find a little bit of asymmetrical risk because Elon Musk just brings so much expertise and capital and resources to the table. Okay, so if you're having trouble with deal and strategy, let's work on the how, not the who. And by the way, inside of Black Card, what we do is we help people connect and find partners in Black Card. One of the huge pieces of Black Card, we have over 1,000 members of Black Card. We connect this. Okay, we help you guys. Sometimes we don't guarantee it, but we help you connect with other people. We're throwing an event at my office in January for anybody that joins before the 21st, which is down below, funlaunch.com/7K off. This is our once a year Black Friday promo. You guys can go talk to a team member if you want help implementing a fund. I will teach all of this for free. If you want help implementing it, coaches, staff, events, come hang out with me in person. That's what we do with Black Card. So that's number one. Making sense? Feeling good? All right, next up, what I would do starting a fund in 2026, I would then okay, we got a pretty good deal and strategy. I think we're doing pretty good. We got an idea here. Next up, let's go structure and think through the whole fund. What I would tell you, I would go consume all of it's a free YouTube content on how funds are built. I'm not going to spend time on it today, but what's your waterfall structure? How investors are going to be paid? Are you going to run an open-ended fund like this? Or are you going to run a close-ended fund like this? What are your splits going to be? How are you going to structure your GP and LP? How are you going to do over here? What type of fund? Are you going to do a Reg D 506B, a 506C, a 3C1, 3C5, 3C7 fund? Like, what are you doing in your fund? I would go map all that out. And I teach most of this, if not all this, for free on YouTube. Again, the implementation costs money, but it's pretty much all for free here. Once it's structured, okay, so Bridget, we're doing pretty good. I've got an awesome deal and strategy. I've structured my fund, meaning I know all the things I want in my fund. Then and only then. Now, most people would say, Bridget, let's go call some lawyers. Let's get this thing going. I was going, hold on. Like I said at the beginning, if you go back to the beginning of this video, that can be a very expensive teacher right there. What I would tell you is do this last stage. Go and actually pitch real world investors. Take your deal and strategy, take your structure, and pitch it as a hypothetical. What you do, go find people that are mentors to you. Find people you look up to, people that you have invested in funds in the past that maybe are wealthy. And you go, and by the way, in Black Card, you come and pitch us. You pitch myself and my team members on your fund. But if you don't have that, if you're not in Black Card, you go just find whoever. Mentors. And you ask them, hey, can I get, I'm putting together this fund. I know you're seasoned in funds. Can I just get your advice on my fund? You've looked at a lot of funds. Do you have 12 minutes that I could pitch you my fund? And I want you to poke as many holes as you can in this offering. Tell me where I'm messing up. Tell me what's wrong. Tell me what's not right. That little hack right there has saved me so much time and effort, and I believe has been a catalyst to helping our two funds launch and be pretty darn successful so far. I believe aggregate portfolio AUM under Fund Launch Partners is over $300 million. Fund Launch Partners and Ugly Unicorn have raised over $54 million of equity in those two funds, and we're just getting started. Okay? This little key has changed it for everything. And this is how we help people launch funds. Again, in the fund launch formula, for people that are doing this, again, in 2026, I would run this same play. So you go ask for advice. They're going to give you advice, by the way. And they might sugarcoat it a little bit. They might say, yeah, you're doing great, buddy. And you go, no, for real. And they go, no, you're doing great. And then you say, well, we're actually putting this together. Can we put you down for just a soft circle of, for $250,000? And they'll say one of two things. They'll go, actually, yeah, put me down. Call me. Once it's ready to go, give me a call. Or they're going to say, I don't know. And you go, hey, right, what holds you back from actually putting your money in? Come on, be honest with me. And then they will tell you the truth. They'll say, well, man, your structure's super wonky. Your team is weird. I don't like, they'll tell you what's going on. And you say, thank you very much. And you can tell this is a circle. So you come back, you tweak your deal. You tweak your frame and structure, and then you come again and you pitch the same person or different people another 12 minutes and say, hey, we fixed some of those holes. What do you think now? And you keep, and I'm coming out of the cleaner version, you keep doing this over and over and over again to find validation. You build a fund that investors want. When we launched Ugly Unicorn, right here, build a fund that investors want. When we built Ugly Unicorn, we did this multiple times. Then we went to legal. And I walked into my lawyer's office. I was like, hey, I want XYZ with a drink and a side of fries. I knew exactly what I wanted because I had stress tested. And he said, great. And he just built me my fund. And that lawyer usually charges, I don't know, $25,000 to $35,000. My fund was built for $10,000 to $15,000. And by the way, in Black Card, we include this as part of your Black Card membership. It's legal is included. But I went and did this, and then we launched. And guess what happened? On our first close, we closed just about $10 million of equity on our first close. Why? And that was a great success. We had our first close. It was awesome. It was like, bam, just right off the gate. Because we did all the work up here to make sure we built a fund investors wanted. Bridger, what if people don't like it? What if I keep doing this circle and I can't really get much? Should I just go launch it anyways? No, don't go launch it anyways, okay? If I can grab you through the camera here, don't just go launch. So let me tell you the other side of this story. I had a fund in 2020 and 2021 I was trying to put together. This fund was going to go buy, this was COVID. All these retail malls were losing money, out of business. We're like, let's go buy them. So our plan was do a distressed fund that would go buy all these malls and we would repurpose them to a higher and better use. We'd put storage units in them. We were going to do all these different creative ways to use real estate that we thought we could get for like 50% off. Because leases, and it was moratorium, no one could charge rent. Like there was distressed owners of retail centers, strip malls, etc., that we thought we could get 50% off. And we actually had a few deals lined up. We did deal and strategy. We framed it out. We went and pitched investors. People hated it. And I thought, I'm a pretty connected guy. I talked to person after person. We pitched it and we had a good team. We had a real estate guy, another guy. We pretty professional fund. People just didn't like it. We went back, we tweaked it, we just pitched, and guess what? We finally said, I don't think this is going to work right now. It's just not the right appetite for the market. We tested the market and we didn't launch. We never did the launch. All we wasted was a little bit of time. We wasted a few months of time. We wasted almost $0. The other person, the opposite person, would have spent $50,000 in legal docs and then figured out their funds sucked. This allows you to test and then guess what happened? 2022, I found some new partners, new team. We then spun up Ugly Unicorn and people loved it. People, yes, that's what I want that. We got validation. We launched, $10 million closed roughly on our first launch. Is that making sense? Yeah? Feeling good? So this is what we do. I'm going to go back up to the top here. So again, Validation, so important. Then we go to legal. Then we launch. Then you're having fun now. Post-launch, you filed your Form D, you've launched. Then we're going to capital markets. We're going to we're actually closing investors here. We're then buying assets. We're going to go buy the building or the crypto or the whatever. And we're going to start building our firm. We're going to bring on, associates, intern, whatever the firm management is. And then we keep doing this forever. You keep raising capital. You keep buying assets. Maybe you launch Fund 2 or Fund 3 and you keep building out a firm and you do this forever. This is how some of the wealthiest people on earth make money. Isn't that kind of cool? So let's get a little granular here. And by the way, drop questions if you have them in the chat. That we are live for a reason. So I want to answer some questions to people that are live. Let's dive into a few mechanics, though. I kind of glazed over a little bit frame and structure. Let's get into a few mechanics. Does that sound fair? Yeah. Let's go down here. So we already talked about deal and strategy, frame and structure. This is how 99% of all private money is raised in the United States. You'd be surprised how much trillions of dollars is raised through this little structure I'm about to explain to you. This is how they do it. I'm gonna clean up my little board here, okay? This is how they do it. They follow, and I'm gonna share two different structures. Number one is the GPLP structure. This is the structure for pretty much how every fund gets set up. This is the same structure for hedge funds, private equity funds, real estate funds, venture capital funds, private credit funds. This is how they run, okay? And by the way, all those fund terms, those are just fancy ways of deploying the capital. Let me explain what you're looking at here. What a fund is, at the most basic sense, a fund is just a pool of money, and this is your pool. This square right here is your pool of money. It's just a pool of money. Here's see that little clip art? I pulled that from Google. There's my pool, okay? My little pool of money. See that right there? Little pool of money. That pool of money goes and invests into things. Whenever those investments make money, it flows back to the pool and gets split between the investors or the limited partners and the fund managers, the general partner and the management company. We'll explain all these in a second. That's it, though. It's not that complex of a game. It's like, hey, put some money into our pool. We're going to go buy, for example, a real estate fund buys, real estate. And whenever the real estate makes money, it flows back to the pool. A private equity fund. What does a private equity fund do? It's a pool of money just like this structure. But instead of buying real estate, sorry, I keep grabbing that thing on accident. Instead of buying real estate, it buys private equity or privately held ownership of private businesses. They just buy private businesses. So people do this, small business owners, they go buy up their competitors. People that buy car washes, there's large private equity firms, Sycamore Partners, they bought Aeropostale, Nine West Shoes, I believe Kohl's department store. They were trying to buy Victoria's Secret a few years ago. That's a private equity firm. They're buying private businesses. That's it. It's still just a pool of money that's doing this. So what's Bridger? Then what's a hedge fund? A hedge fund is the same structure. We help people do this like day in and day out. I run a hedge fund. It's the same structure. Instead of buying real estate or privately held businesses, a hedge fund buys public businesses or public securities. Stocks, bonds, options, crypto, foreign exchange would just be a hedge fund. They actually all are structured the same way. Y'all following? And this is the structure. The structure is this. You have a pool of money. Now, they don't call it a pool of money. They call it, I'll erase this here. You still got my clip art, though, from Google. Clip art from Google. Pool. There's my diving board right there. My pool of money. It's called a limited partnership. And we don't have investors. We have limited partners. And limited partners invest money into a limited partnership. You can see my little money signs here, okay? And that limited partnership is governed or managed by a general partner. So there's general partners and there's limited partners. The limited partners are limited on their liability. They're limited on their control. They're passive investors. A general partner is me and you, the fund managers that oversee what everything happens. Kind of cool, yeah? Now over here, you also have a management company. You usually split these. They're usually owned by the same people. I'm just going to put like you. You would own this one, and you and your partners would also own this one. Management company, this is where you collect your management fees. This would eventually be your RIA, a registered investment advisor or investment advisor, would be this entity here. We'll get to that later. All of this, though, that I'm just talking about, I'm grabbing weird stuff here. All right, zoom out. Come on, iPad. Here we go. All of this stuff is governed by what we lovingly call the Bible. This is your LPA. These are two agreements. These are legal documents. They are thick legal documents. They're about 200 pages each. And these two documents govern all the rules and bylaws of your fund. Now, what's cool about funds is you and me get to write the Bible. We get to decide what goes into the limited partnership agreement. We get to decide, we can write down, hey, okay, the minimum to invest is $50,000 is the minimum check that a limited partner can invest into this fund. And we write that down in our little Bible, okay? We say, this fund is going to last for 5 years. And we write that down in our little Bible. We get to decide what we want to do, which is pretty cool. I know some of you in the chat are going to ask me, hey, Bridger, can I buy real estate and Bitcoin and other stuff all in the same fund? The answer is yes, you can. You just write it in your Bible. Yes, this fund is going to buy some Bitcoin and some real estate and some other stuff. You could do that. Now, do you want to do that is a different question. I would probably say no, but you could do it. You put it in your LPM, PPM. There's actually a lot of things that you decide as the fund manager. Now, once it's written, it is written. That's why we call it the Bible. Once it's written, though, you rarely change those things. Like it is concrete. This is how your fund will run. This is the Bible. You following? But again, you get to decide a lot of terms of the Bible. This little structure right here is how 99% of private capital in the world is raised. Following? By the way, type any questions if you have them in the chat. This is sweet. So, and then I'm going to share as we're on this topic, if this is useful, by the way. And by the way, again, like I said, we teach all this for free. Implementation is what we help people with. So if you want help, we're doing a pretty cool promo, $7,000 off. I got my golden ticket. You can hit fundlaunch.com/7K off. Talk to one of my team members, all right? Now, I'll come over here. Inside of these funds, again, we're back to the topic of how 99% of private capital is raised in the U.S. They use, number one, this GPLP structure, and then when they go file with the SEC, which is the Securities and Exchange Commission, the little filing that you do is called this. It's under Regulation D, and it's 506B or 506C. And you can see the distinction. I won't go deep into this unless you guys want me to, but you would file under a Reg D. Most of the time, people do 506Bs. As of recent, funds have done 506Cs. This is where you can raise unlimited amounts of capital. You can see here, a 506C can only raise from accredited investors. A 506B can raise from 35 non-accredited investors, and then the rest have to be accredited or above. 506Bs cannot advertise. 506Cs can advertise. And you have to verify accredited investor status, and this one, the fund must verify accredited investor status. My two funds are 506Cs that I currently run. My first fund was a 506B. I now sold that to a competitor. And then below that, you'll select if you're doing a 3C1, a 3C5, or a 3C7 fund. These are all SEC filing codes that, again, a lawyer or someone, a compliance person can help you make sure you make the right decision. But this little code, this is how people go out and raise hundreds of millions, billions of dollars. And they do it as a private offering, usually through a 506B. Some of them do 506Cs, more of a public. They can actually do, it's not a public offering, but they can generally solicit their private offering. And this is why, again, you don't see, advertisements from Blackstone, the private equity firm, or KKR. You don't see advertisements from them because they, by law, cannot generally solicit the public to invest. These are private offerings. So I'll tell you a quick story. So I mentioned Ray Dalio earlier, right? So Mr. Ray Dalio, he ran Bridgewater. I think they're roughly a $150 billion hedge fund. One of the largest on earth. Crazy. This has made Ray Dalio a deca-billionaire, okay? They launched a Reg D 506B. They also launched a 3C7. They could only raise from 1,999 investors. So what they did, they said, all right, well, we're raising lots of money. It's a Reg D 506B, right? Sorry, I got distracted by the chat. I'm just going to start reading your questions here in a second. Their minimum commitment was $100 million to commit to their fund. You had to have a $4 billion net worth to even think about investing into their fund. Isn't that crazy? It's because of this rule right here. They can only take from 1,999 investors, and all investors must be qualified purchasers. And so what they did is they essentially said, well, all right, we got to fill up each spot. They raised this whole fund, and they stopped raising in 2005. I believe since 2005, they've accepted no more investors in this fund. That's how exclusive these funds are. And they couldn't even advertise it. They couldn't generally solicit it. They had to do it through private contacts. Isn't that crazy? Now, the reason for this is because it's a private offering. If you were going to do a public offering, like a mutual fund, then great, go advertise it. It's a different classification. You have a higher degree of compliance and regulation. These are less regulated. They're exempt from a lot of regulations. And because they're exempt, they can only raise from a certain set of investors. And sometimes they can't even advertise what they're doing. But it exempts you from being like a public company or a mutual fund or things like that. Does that make sense? Kind of a cool story from Ray Dalio. So I'm going to zoom out again. So if I was building a fund in 2026, I would follow the fund launch formula. I would make sure to start with deal and strategy, frame and structure, verbal commitments, get validation, go to legal information. I failed to mention one thing over here. Back to it. I'm jumping around a little bit, and then I'm going to questions right after this comment. Let me go down to the cleaner version here. Let me clean it up a little bit. When starting a fund here, and at the bottom, there's a little phrase I love. If you go and do this and you start pitching people for money, if you go pitch people for money, you generally get advice. People will tell you why you're an idiot and why you're annoying and like, stop pitching me for money. But if you ask for advice, you generally get money. Again, back to this. So you're going to frame out your deal and strategy. You're going to go work on your frame and structure. You're then going to go ask for advice, not money. You're asking for advice on if your fund offering is good. And what's the funny thing about it, when you ask for advice, you generally do get money. But you're going to keep iterating and working until you build a fund that investors want. You can see right here. Okay? That's the goal of building a fund. Now, like I said earlier, I'll go back to this. Again, I'll teach all this for free. If you want help implementing this in your business, if you're looking to do a fund, we have now helped hundreds and hundreds of people launch investment funds. We have our flagship product is called Black Card. I think we've had over 1,000 people go through Black Card. Black Card, right now, we're doing something pretty cool. It is $7,000 off the purchase price of Black Card. You also can start for $5,000 down, and we will finance the payment plan for you. Okay, so book your call. It's fundlaunch.com/7K off. You also can text this number. And in here, it's going to be a little blurry. I copy and paste, but you get our four-phase incubator, our one-on-one coaching, custom pitch deck, full fund legal build-out, Fund Launch 360 marketing tools. We have a mastermind workshop. We're actually throwing our next one at my office in January, right after the New Year, after Christmas and holidays. Come to my office. We have a full court basketball court for 2 days. We're going to work on building your funds. Okay. If you want to book a call, and again, this is no commitment, just book a call and talk to my team members, see if it would be the right fit for you. Now you might ask, how much is Black Card? It depends. That's why I don't have a price on here. It depends on what you want. You actually can pick and choose what you need for your fund. But I shared earlier publicly, an average price is about $35,000 total for Black Card. You take $7,000 off of that, you're looking at about $28,000 total. But you can break that up. We do $5,000 to start, 0% interest payments, and that includes the legal cost. Remember that $30,000 to $50,000 I was talking about earlier to launch your fund, wherever that was? That cost is actually included in Black Card. That's part of the cost. So I mentioned about $28,000 is like an average. You can go lower or higher than that depending on if you have partners or team members or whatever. Let's call it, that's a rough estimate. That includes the legal cost you would spend anyways with a lawyer. So it's the legal cost plus 15 coaches, 30 plus legal or other partners we have that plug in, tax, audit, accounting, compliance partners that plug into Black Card. It covers all of that. It's kind of like having all these people, Fund Launch 360, a legal team, interns, account managers, coaches, capital raising events, discounted audit and tax, and Fund Launch partners. That's our current fund that all is investing, thinking, talking about, working, and helping you. That's the goal of Black Card. And we have dozens of testimonials you can see from real life people that have been in here. We don't want to hide anything. You can come on, hop on a phone call, ask every question you have. We want to make sure it's a good fit. Down below, fundlaunch.com/7K off. All right, I'll leave that live for 1 second. Let's pull up questions. I'm going to go to the Q&A here. So if you're live on YouTube, I'm reading the YouTube chat here. What's going on, y'all? So drop questions if you have. Can a fund have only one GPLP? Can a solopreneur start a fund as a solo operation? Yeah. So back to the GPLP question. Can a fund have, GPLP? So yeah, you could have one person here and just the same person. It could just be you here as well. Now the limited partnership, the fund, also, yeah, you could just have one big investor that comes into the fund. Now, if it's you, if you're the person investing, typically that comes through the general partner. So the general partner contributes to the fund, and you would have no limited partners. There'd be no limited partners. And you'd have a pretty simple, you actually don't even need an LPA and PPM, or a very simple LPA and PPM because there's only one investor. But yes, the other question is sometimes there's just one manager here and there's one large investor that wants to give you, $100 million. They call that a fund of one. So you have one big, like the St. Louis Fire Department pension plan wants to give you $100 million and they want to be the only investor. Great. They would still come in here. You tailor your LPM, PPM for them, and that's how that works. Yeah, good question. Is there compliance preventing a fund manager to invest in his own projects with full transparency? No, that's actually encouraged. So in your fund, you should, and back to this, you should be investing into your own fund. As the general partner, you want to have skin in the game. Right now, me and Dan, I think both of us, we have every day it changes in our fund because we're in crypto. We have roughly $1 million of capital in the fund each. So about 2 million total. And so when I pitch an investor, I say, hey, my money's right alongside yours. I have skin in the game. My money's right with you. And the general partner would invest into the fund. Yeah. Yeah, that's encouraged, very encouraged in funds. Now, you might not have $1 million to invest. That's okay. As long as I think it should be a significant amount of your net worth. That's how you answer that. So if someone asks you, hey, are you investing in the fund? You're like, yeah, I have a significant amount of my net worth. Invest in this thing. I want to make this thing work. And you should believe in it. It should be the best investment that you have found. You're like, hey, I looked high and low, far and wide, and this real estate project on 123 Main Street is amazing. I'm putting a significant amount of my net worth in the project, and I'm trying to round up as many people as I can because this project is amazing. Now, on my first fund, I put in $30,000 roughly. To me, that was a significant amount of my net worth. Now, I just mentioned today it's about $1 million in my fund. Okay? Again, it should be a significant amount of your investments should be in that. Good questions, y'all. Keep typing in the chat. Will a private debt direct lending fund have the same GPLP structure? Yes. Yep. So my first fund was a private lending, private debt fund. And we did the same GPLP structure. Yes, this is for you. What if I already have the land, but not the investors to develop it? You have 8 acres. So what you can do, some of you might already have the asset. Maybe the asset's over here, like the land. Let's put land here. So what you can do, once the fund is live, number one, you could just contribute the land. If you already own the land, you gift it to the fund in exchange for shares of the fund. In another sense, the fund is buying it from you. Now, if you're going to do that, make sure it's done at fair market evaluations or even below fair market evaluations because you want to be a fiduciary which means you have the best interest for the fund. You serve what's best for the fund, not for what's best for you. So if you have land or whatever you want to contribute to the fund, you say, hey, we're doing this, the land is worth $1 million. And guess what? We're going to sell it to the fund for $900,000 because we want to do what's best for our investors in our fund. We're honest. And so the fund is going to buy it for $900,000. That's how that would work. But yeah, it's called wholesaling your property into the fund or deals into the fund. Yep, that can totally work. And again, a lot of these questions, we work with you one-on-one in Blackheart. Again, if you want help implementing this, funnels.com/7K off. Let me go up here. Can you start out by running as a fund and then later transition into or build out a true holding company structure? From John. I guess what's your end goal? Maybe give me more context of the holding company. The fund would hold the assets. Like the fund buys. Did you say what type? I don't know what you're doing. Maybe give me a little more context though. But yeah, the fund would hold those assets. They can be they can be sold out to a long-term holder. But again, back to this though. The goal of the fund. You are a fiduciary. When you take other people's money, it is a big deal. When you go and actually raise capital, it's a big endeavor. This is not to be taken lightly. You got to be buttoned up. You got to be compliant, and you have to do what's best for the fund. Also, you don't serve individual investors. It's not what's best for the individual investor. You do what's best for the fund, which actually is a cool thing about funds. Let me give you an example. So in some people, set up, and I might get a question on this, like SPVs, which stands for special purpose vehicle. Okay, this is essentially where you set up an LLC and just people come in and put money into the LLC. Everyone buys a little piece of the LLC and then you go buy something. Very common. The problem with an SPV is with fiduciary duty, and I've seen some of these go pretty wonky pretty fast. Now, if everyone makes money, everyone's happy, no big deal, but it's only when people lose money that things go a little wonky. Let me give you an example. I'll use this up here. Let's say you had a fund going, and this investor right here, I'll change colors. I'll go blue here. This investor right here calls you up, and let's say we raised $25 million, and we went and bought some real estate projects that we're developing right now in some great spot. And this partner calls you up and says, "Hey, Bridger, I love you guys. You guys are awesome, but I forgot to pay my taxes last year. I have a huge tax bill. Can you sell the assets so that I can get some money out of the fund and pay my tax bill?" Now, if you were in an SPV, a special purpose vehicle, you may have to do that. And they're like, "Well, if you don't sell, I'm going to sue you and elbow you out." In a fund like this, you go, "Sorry, the real estate is not ready to sell yet. We're still mid-construction. We can't sell it. If we sold it right now, we'd sell it for a huge discount, a big loss. I have a fiduciary duty to do what's best for the limited partnership, the fund as a whole, because I have other investors. I got all these other investors, and it would hurt them if I sold this to just help you with the tax bill. So sorry, I cannot sell the real estate." And they might moan and groan, and you just say, "That's what you signed up for in our LP and PPM." This protects investors against each other. If one investor has a big tax bill or a judgment or something, you, as the fund manager, still do what's best for the limited partnership, not individual investors. Now, that investor, what can happen is you can say, "Hey, well, you have options. You could sell your ownership to maybe another investor would buy you out." That's called a secondary. Most LPs, PPMs have an exit clause that say, "Hey, yeah, you can sell out, but it's a 50% penalty." So yeah, you can sell your shares, but it's a 50% penalty. We actually had a guy in my fund. He got tied up in some big project. He needed out. It was $1 million. And we were like, "Sorry, we can't, the money is locked up and we can't just exit you today. You can wait." We have a 90-day clause plus the next quarter mark. So it was going to be, I think it was 120 days or something that he had to wait to get his money out. And he said, that's not going to work. I need my money now. So we just put him in touch with a few other investors, And they negotiated a deal, and I think they ended up buying his shares for like $900,000, a 10% discount. It's called a secondary transaction, and we didn't. The fund stayed the same, but those units went from one investor to, I think, two other investors bought those out. Okay, is that making sense? All right, let's keep going here. Good questions, y'all. Type questions if you have them in the chat. We'll stay on for a few more minutes. Again, if you want to talk more or talk to my team members, fundlaunch.com/7KOFF, or just text that number below. Say like, hey, I'd love to talk to you guys. I'd love to hop on a call. Type that down below. Okay. Thank you, Bridger. Thank you for your content. That's my skin in the game. Oh, that was the question earlier. Yeah. So you could contribute a property. Yes, yeah. You'd say, hey, I have $1 million property. I'm going to contribute it to the fund. In exchange for that, I'm going to get units or shares of the fund. It's like I contributed $1 million. It was just a like-kind transaction, and you put in there. And also, I would check with a tax person to see if there's a tax consequence. I don't believe there is, but I would confirm that. So anyways, yes, that's very common. Yep. World of Reg. Yeah, you can totally do that. Okay, discuss all the legal docs required. There's a bunch more. The two main ones, though, are LPM, PPM. In here, though, you have an investment management agreement, which is a contract between this and this company. You have operating agreements for your management company, and you have an operating agreement for your general partner. You have subscription documents. There's a few other documents you get once you build the whole thing out. But again, the core main documents are your LPM, PPM. Hey, Bridger, does a hedge fund incubator with smaller AUM also fall under one of the Reg D categories? Good question. So a hedge fund incubator, let me erase this. So a hedge fund incubator is actually a really cool thing. And we help people do this at Fund Launch. So incubator, hedge fund incubator. Okay, there's my hedge fund. Hedge fund incubator. What a hedge fund incubator does, it sets all this up. But you don't raise money from limited partners. You only bring on partners through your general partner. You bring on I usually keep it small, 3 to 5 people. So you have family or friends that want to give you, $100,000 or $200,000 to invest in the stock market. They come in here. The general partner contributes to the limited partnership. You have a pretty bare bones, you have essentially an operating agreement that covers this. You don't need an LPM, PPM. Because you're not raising money from limited partners. The question was, do I need to file as a Reg D 506B or C? It's a good question. I'd ask an attorney. I want to make sure I answer the question. I don't believe you need to, because you're not raising capital from investors. You're just bringing in partners to the general partner. And so this is not an offering that you need to file with the SEC, I believe. Now, confirm with an attorney. This is not legal or financial advice, but I don't believe you need to. Now, you might want to, though. No, this is the Reg D is a notice. You're filling out your Form D. It's a notice to the SEC that you're raising capital. No, I don't think you do. I don't think you raise it. Yeah, I don't think you do. But again, confirm with an attorney. You might want to just do that just to file it, just so you have a timestamp. The purpose of a hedge fund incubator is to build a track record. And so by filing a Form D, it shows like, oh, back in 2025, we filed a Form D that we started our hedge fund and now, raising money. But I guess you could ask an attorney on that. I don't think you need to, though. Good question. All right, let's keep going. Bridger, so my dad has a pretty good sized landscaping company here in Kansas City. What kind of fund would you recommend? Real estate or private equity? Is the goal to buy more landscaping companies or to actually buy real estate? Now, that being said, and I guess that's a good distinction, they're both structured the same. Whether you're buying real estate or other companies, you would still use the same structure. The only difference would be maybe exemptions over here. This, you could, if you're buying real estate, you have a 3C5 exemption. And that, you have to have 80% of your assets in real estate. That'd be the only differentiator. But they're going to be structured they're almost exactly the same. Goal is speed and freedom, unless I'm wording it wrong, and fund can be an easy or better than holdco. I think that was a question earlier. The holdco would be to adapt instantly. I'm not understanding what you're saying, John. Maybe write it all out for me one more time of what you're asking. Maybe I'll come back to you in a minute. Can the holdco company be an LLC or does it have to be a limited partnership for the incubator? Can the holding company be an LLC or does it have to be a limited partnership? Oh, for this. So these are LLCs. This is an LLC. This is a limited partnership. You in an incubator, you could have this be you want to have it be a limited partnership actually. And to have a limited partnership, you have one limited partner. That would be like you. You would just be your solo limited partner. I think you want to keep a limited partnership so that you have an entity that can build a track record and you can get audits done on this. Now, could this be an LLC? Theoretically, yes, it could be. But I think you want to follow the general partner limited partnership structure so that in a couple years from now, when you're ready to run a full hedge fund, you say, hey, we've already been running this. This is our case study. We have audited financials. You can see our returns here. They're not cherry-picked returns. These are returns actually from our, limited partnership. So that's what I would say. Yeah. Hope that's helpful. By the way, fundlaunch.com/7K-off. We'll update the timer too on the top as people, when you join, it actually claims your 7K off when you book a call. So yeah, we'll keep going though. Keep asking questions here. Has FundLaunch partnered with any GPs from India or help in launching real estate funds? We have a number of people from India that are in Black Card. Yes. Do they live in India? No. We have a lot of people that are Indian that live in the United States or the UK inside of Black Card or Canada. I don't believe though, I don't think we don't have a good structure for launching Indian funds in India. So no, I don't think we probably wouldn't help you much there. But if you're in the United States or if you're in Canada or the UK, yes, we can help all those types of people in Black Card. Yep. Or Canada. Yeah. I'm in the same situation. I have 15 acres ready to develop. Yeah. So people that you already have just to come back to this, if you already have the land, you would contribute the land to the fund essentially as your GP commit. It'd be the same thing. And what would happen is you get shares of the limited partnership, just like you had committed capital. It's just a like kind. Instead of committing money, you're committing land. Yep, that's very common. That's done quite a bit in funds. Has FundLaunch, hi Bridger, do I need to create both legal entities then? I mean the GP and the management company if I want a fee structure composed of management fees and the carry. Yes, typically, yep. These are usually new entities that are created. You want to keep them, you could use old entities, but I keep them clean. They're usually brand new entities if you're doing a brand new fund. And by the way, we do this in Black Card with you. So inside of Black Card, when you join, we help do your general partner. We create that entity. We create the management company entity. We create the limited partnership. We help you create the LPA and the PPM and the sub-docs and the investment management agreements, all included in here. That's what we do in Black Card. So if you're like, how do I do this? We do that in Black Card. This is going to cost you $30,000 anyways to set up. Black Card, I mentioned earlier, you have this cool discount of 7K off. It's going to be on the average right now is about $27,000 inside of Black Card. Here it is. And you can start for $5,000 down with 0% interest payment plans. So that's pretty cool. You can go claim your golden ticket here. Fundlaunch.com/7K off. Okay, pretty good, y'all. Drop any final questions if you have them. Let's do a giveaway as well. If you guys are here, we'll do a final giveaway. You guys stay to the end of the call. We'll wrap up. We're going to give away $100 to Amazon. Type a yes in the chat if that's you. So type a yes in the chat if you're here to the end. $100 to Amazon for someone who stayed on. Again, fundlaunch.com/7K off. This will be live on YouTube. You can go watch the recording here. Again, talk to my team though. There's, if you're curious, if you're like, I think that might work, just talk to our team. We'll give you the ins and outs of it. And there's no commitment. You just book a call, hop on a call with our team members, and we'll get going there. So type a yes in the chat. I'm gonna pick somebody here in just a second. Type a yes. And then again, the fund launch formula. If you missed the beginning, go back to the beginning, but go and build your deal and strategy first, frame and structure. Then go and get real world advice. Ask for advice. You generally get money. for the goal of getting validation. Then and only then do legal formation. Then you launch. Then you go and actually you close the capital, get it wired into your fund. You go build your, actually start buying the assets here. You go build out your firm and you continue to do this. All right. I love it. Let's select somebody here. Keep typing yes in the chat. 5, 4, 3, 2, 1. All right. I see Calvin Arterberry. Calvin Arterberry. I think I said that right. Calvin Arterberry. You got $100 to Amazon. You can drop your email in the chat or just message my team at Bridger@funlaunch.com. Yeah, pretty cool. By the way, on the bottom of this, we just dropped our merch store. It's live down below, so go check that out. All right, you guys are amazing. We're going to wrap up today's call. We're going to be live next week. We want to do more of these live streams. We're thinking every Thursday. So Thursday, same time, same place. I'm going to keep doing these live streams. We're going to see if, I don't know, some of you guys like this live stream model. So come on, put it on your calendar for next week. Live stream Thursday, same time, same place. And we will see you all there. All right, well, peace out. Bye-bye.